dividend problem that I'm going to walk you through. So if you're not familiar with this problem, go ahead and pause the video before we start to walk through. The first step of this problem tells us that the company had dividends in arrears, and they're also going to provide a current dividend for preferred stock, and then they're going to have a $3 per share common stock dividend. So the first thing we're going to do is take care of this transaction. We're going to both figure out what happens when we declare and distribute that dividend. So I'm going to show you how we're going to first thing would be to calculate the amounts here, and then to do the journal entries. So to calculate the amounts, I've created this spreadsheet here. We need to take a look at preferred stock and understand how that works. Preferred stock has a par value, in this case, of $100, and we're told that there's a 7% something, and that 7% indicates what the dividend amount is on the stock. And so it's 7% of the par value. In other words, each share that is owned will be guaranteed a $7 dividend each year. We take that $7 and we multiply it by the shares outstanding, which we're told is 4,000. And so that indicates that for this company, they have $28,000 in preferred stock dividends they're on the hook for each year. Now, what I've done is down here, I've kind of made a summation of all these different dividends that they're on the hook for, which includes 1 year's amount in arrears. In other words, they didn't pay the dividends for 1 year prior, so they owe 1 year's worth, plus they're going to pay the current year's dividend of another $28,000. And then we're told that there's a $3 common stock, $3 per share dividend that we're going to also pay out. There are 15,000 shares outstanding of common stock, and so there is a $45,000 additional amount of dividends. So you add those three together, and that tells us that we're going to declare and distribute $101,000 based off of this transaction only. Next, we'll record the journal entries to take care of the dividends distributed and declared. So the first thing we are going to do is we're going to create the journal entry for declaring the dividends. Every single time we declare a dividend, it always gets pulled out of retained earnings. So I will always debit retained earnings, and in this case it's going to be for the $101,000, and I'm going to credit this liability account called the dividends payable for preferred, and that's going to be for both the amount in arrears and the current amount. And then I'm also going to credit the dividends payable for common stock, and that's the journal entry to declare the dividends. I've showed you over here what the T account would look like and why we actually debit retained earnings. A dividend is a distribution of profits that have been previously earned by a corporation, and so by debiting retained earnings, we're taking some out. So really the T account would look like that after that journal entry. Then when we go ahead and distribute the dividend, we're going to now we would have preferred $56,000 that we owe, and we're going to pay it. So we debit the dividend payable. That would in essence wipe out the dividend that I show as owing for preferred, and I do the same thing for the common stock. I'm going to pay that with cash. So my debits have to equal my credits. So I would have distributed the dividends appropriately. My T accounts, after I posted those entries, would look something like this. When I booked the first common stock dividend, increased. I paid it, it decreased. The net effect is it goes back to zero. Now we'll move on to the second transaction right here, which says that the company had a 15% stock dividend on common stock, and the current market price of the stock at the time of this dividend is $28 a share. So the first thing we're going to want to do here is I've made a little summary of the common stock of the information we're told, that there are 35,000 shares authorized, there are 15,000 outstanding. So when we declare a stock dividend, it's different from cash. Obviously, we're just giving them additional stock instead of cash. And we're going to give out 15%, not of the authorized, but of the outstanding amount of common stock. So we're going to issue another 2,250 shares. So this, I guess, could be moved down here. And we're told that the market value is $28 per share when this happens. And we're also told the par value of the common stock is $5. So most people at this point can't quite figure out, or they get confused as to what's the total value of that dividend that's been declared. And we're going to take the 2,250 shares that we're issuing, and we're not going to take the par value. We're going to take the market value. So we've just declared a $63,000 dividend. Not dividend. But here's what the journal entry would look like. Every time we create a dividend and declare it, we always debit retained earnings. It's a distribution of profits within the company. We're going to credit dividend distributable, not payable. We're not paying anything. And so when we declare a stock dividend, this is what it would look like. Then when we distribute that dividend, it looks a little bit different. We're going to take and zero out the dividend distributable, and we're actually going to issue the common stock. Now here we're going to need to take the total shares that we're issuing times the par value. That tells us how much additional common stock has been issued. Then we have paid in capital in excess of par, which is going to be for the difference. If you did this math, it would also be $22.50 times $23, which is the market price minus the par value. Final transaction here says that there's a $2 per share dividend on common stock only and everything outstanding. So first we have to calculate how much stock is outstanding. We originally had 15,000 shares outstanding. We declared a stock dividend of another 2,250 shares. So now the total amount outstanding is 17,250 shares. That's really the trick of this last problem. So you take the $2 per share, you multiply it by the new amount outstanding. That tells you the total value of this dividend on common stock is $34,500. So at this point it's actually very redundant when you compare it to the other problems we've done. So we declare this dividend by debiting retained earnings, crediting dividends payable for the same amount, and that's it for declaring the dividend. And then distributing the dividend is zeroing out that liability and crediting cash. And that's it. That concludes this problem.